Alright, good day everyone. Welcome to another session of 4 tutorials. And today we are going to look at assets, liabilities and capital. So, assets, liabilities and capital. This is what we are going to look at, assets, liabilities and capital. We are going to take each of them one by one, try and explain and understand what they mean and how they apply to financial accounting. Alright, so we begin with assets. We take them one by one. What is an asset? Obviously, everyone knows an asset is a property of an organization, right? Yeah. So assets are economic resources of every organization that they use to generate revenue. So assets are economic resources that are used by an organization to generate revenue. Now, for every asset, it should be certain that there will be some future economic benefits that will flow to the entity from the continuous use of that asset, and that qualifies it to be an asset. So an asset is an economic resource of an organization that is used to generate revenue. That is an asset. Alright, so we have basically two broad classes of assets or types of assets. We have the non-current assets, and then we have the current assets. These are the two types of assets that we know basically. Now the non-current asset is what is previously called fixed assets. That is what is previously called. Okay, so we have the non-current assets and then we have the fixed assets. These are the two broad classifications of assets that we have. Of course, there are other types of assets that we may also have, which we are going to look at. Okay, so but for now, let us focus on these two, non-current assets and then a current asset. What is a non-current asset? A non-current asset is an asset that is purchased to be used permanently by a business, and the benefits of which goes beyond one accounting year. I repeat that the benefit of a non-current asset is expected to go beyond one accounting year, and it is procured with the intention of permanent use and not for resale. And that is the most important thing. Now, current assets, on the other hand, are assets that are bought for the intention of reselling. So assets that are acquired not for permanent use in the business, but for conversion into cash. We are going to resell them to make cash. Then it becomes a current asset. So these are the two differences between the non-current assets and the current assets. Now, classifying an asset as non-current or current is not about the nature of the assets per se, because it may change depending on the type of business and the nature of business. But I always advise that it is dependent on the intention for acquiring the asset. We have to consider the intention. What was the purpose of acquiring the asset? Was it for resale or for permanent use? Was it for conversion into cash or for permanent use? The benefits that we are going to derive from the continuous use of this asset, is it going to be more than one accounting year, or is going to be consumed within just one accounting period? That is the basis for defining whether an asset is a non-current asset or a current asset. Of course, we can have a basic examples. For the non-current assets, we can have, normally we see lands, buildings, motor vehicles, and other physical properties that are mostly of capital nature. They are seen as non-current assets. But I always want to add that for some organizations, for example, if you look at a computer or an office computer, for example, we are always tempted to say that it's a non-current asset, which is true when it is being used in the office. But then let us also consider a business or a company that deals in computers. They buy and sell computers. So you see that when they acquire computers for the purpose of resale, the computers then become a current asset, because the purpose of buying the computers is for resale and not for permanent use. If they buy the same computers and they take one for the office use, for permanent use, it becomes a non-current asset. But if the computers are bought in stock and the purpose is for reselling to make cash, it means that the same computer will become a current asset. So sometimes it's not necessarily about, the focus is not really on the type of the asset, but it's dependent on the intention that we use to acquire the asset. So that is basically how we differentiate the non-current asset from the current asset. We have said earlier that literally assets are properties that the business have that they use to generate revenue, okay? And we have the non-current asset and then we have the current asset. So examples of the current asset we have stock. And when we say stock in trade, like I said, in the case of a computer selling company, their stock is the computers. In the case of a clothes selling, like a boutique, their stock is the clothes. In the case of a food vendor, their stock is the food in stock. So we see that stock becomes a variable, it changes depending on the nature of the business. And that is why I'm saying that every stock is a current asset, because the purpose of acquiring a stock is for resale. And then we can also have receivables. Okay, so examples of this, we can have stock as an example, and then we can have receivables as an example. All right, so receivables are also current assets, in a sense that initially we used to call it debtors. Okay, all right, we used to call it debtors, but then as accounting is evolving, we always say that debtors is not appropriate to be called an asset. There is a difference between a debtor and receivables. Now, a debtor is the person who is owing you. Receivables is the amount the person is owing you. Now, let us judge the person himself or herself, and then the money that the person is owing you. Which one is your asset? Is it the person that is your asset, or your money with the person that is your asset? And so, as accounting is evolving, we have come to understand that it is wrong to call the debtors our assets, but rather the receivable is the asset. Now, stock is also called inventory. Okay, so for those of you who would want to know, stock is also called inventories. All right, so receivables is an asset, and usually it doesn't take more than a year to benefit from. Then we can also have cash, which is also short term. Now, cash can either be at the bank or cash in hand, and then we can have short term investments. These are all examples of current assets. Now, for the non-current assets, we know that buildings are there, motor vehicles, most of them are of capital nature, and then those are non-current assets. They are used in the business for more than one accounting year, and the benefit goes beyond one accounting year, and the intention for acquisition is not for resale, but for for permanent use. Now, there are other forms of assets, other types of assets that we can look at. There are other types of assets that we can look at, like we can talk about tangible assets, and then we can talk about intangible assets. Then we can talk about liquid assets, and then we can talk about wasting assets. And then we can also talk about fictitious assets. All right, so these are other types of assets that we can look at. But like I said earlier, the main broad classification is between the non-current assets and the current assets. All these other types of assets fall under these. Now, a tangible asset, for example, can be a non-current asset or a current asset. Intangible can be here or there. So these assets all fall under this. But we just try to bring this out to explain so that we will also get a more comprehensive understanding on assets classifications. So when we look at the tangible asset, as the name suggests, anything that is tangible has physical existence. So a tangible asset is an asset that has physical existence. That is, it can be seen and touched. Okay, so we have a lot of tangible assets. If you take many of the stock in trade that we have, our buildings, our motor vehicles, our land, once we can see them, they have physical existence, they are tangible assets. Now, we can talk about intangible assets, which are also assets which do not have physical existence. A typical example is goodwill. Goodwill is an asset but does not have a physical existence. And then we can maybe talk about investments and other intangible assets, assets that cannot be seen and touched. They do not have physical existence. Then we can also look at liquid assets. Now, in accounting, when we talk about liquidity, we are not referring to the science definition of liquidity. We are talking about, in a way it's related, we are talking about how fast an asset can be converted to cash. Okay, so liquid assets are assets that are easily converted to cash. You can easily change them into cash. Those are liquid assets. And then we look at wasting assets. Now, wasting assets are assets that decrease in volume through usage. So as you continue to use the assets, they decrease in volume and in quantity, and they decrease in volume and in value. So example of a wasting asset are natural resources like the mineral deposits and sand deposits. And those mineral deposits, the more you dig and then you extract your minerals, the deposit strength, you lose the quantity of the deposit, and that is an example of a wasting asset. And then we have what we call fictitious assets. Now, fictitious assets are debit balances that exist in the books at the end of the financial year for a value. Sometimes you do not know where exactly you get them from, but through operations, you can just get debit balances existing in your books at the end of the financial year, and those are called fictitious assets. So these are other examples of assets, and each of them will either be a non-current asset or a current asset. So these are the two broad classifications, and these are other types of assets. Alright, so then we take the other one. The next on our list is liabilities, and so let us look at liabilities as well. What is a liability? What is a liability? Now, a liability, I define a liability as a financial obligation of the business to outsiders. Okay, the financial obligation of the business to outsiders. Literally, we mean that the debt that you owe as a business to outsiders. So once you owe that you're supposed to pay, you are liable to. Okay, and a liability is expected that this obligation will cause an outflow of cash or an economic decrease. Okay, there will be an outflow of cash in the future because of this liability. It is caused by a past event. Something happened in the past, and then it arose in the liability came about. And when the liability came about, you are expected to settle it in the future. And so a liability is a financial obligation of the business that they are supposed to settle to outsiders in the future period. Alright. There are also two main broad types of liabilities. We have the non-current liabilities, just like the assets. And then we have the current liabilities. Now, the non-current liabilities is also called long-term liabilities by many people. Okay, so these are the two broad classes of the liabilities. We have the non-current liabilities, and then we have the current liabilities. And so we are going to take them one by one. What is a non-current liability? A non-current liability is a financial obligation that the business usually has more than one accounting year to pay or to settle. So you owe somebody, or you owe a supplier, you owe a bank, you owe outsiders, but you have more than 1 year to pay. That is a non-current liability. The benefit or you use it for more than 1 year and then you pay later. So a liability that the business typically has more than a year to pay is called a non-current liability, and the opposite is a current liability. A current liability is a liability which is expected to be paid or settled within one accounting year. So an example of a long-term liability can be a loan. Now, a debenture is also a long-term liability or non-current liability. And in the case of companies, preference shares are also seen as non-current liabilities. And then we have bonds and other forms of non-current liabilities. Once the business has more than one accounting year, sometimes 5 years, 10 years, and all that to pay, then we classify all those liabilities as non-current. Now, current liabilities are liabilities that typically a business has within a year you have to settle. And examples of current liabilities can include your payables, and then we can also talk about your tax liabilities to the tax authorities, and there could be dividend payable in the case of a company. Now, there are a whole lot of current liabilities, but I always want you to understand that in your accounting practice or in your studies, when you want to classify a liability as current or non-current, it is about the period of time that they have to pay. Now, payables are, payables are also what we used to call creditors. Creditors, trade payables, we used to call them creditors. Like I said, a creditor is the person that you owe, and the payable is the money that you owe. Now, which of them is a liability? Is it the person or the money? So we typically say that the money that we owe is a liability, and that is why payables are more accepted than creditors in the preparation of financial statements. Now, tax is also a liability, and it's a short term or a current liability because usually we have less than 1 year to file and pay our tax returns. And then dividend payable. I don't think shareholders will be happy that the dividend for 2019 will be paid in 2021. No shareholder will be happy with that. So usually we have within 1 year to pay the dividends to shareholders. Of course, there are other forms of current liabilities, but I just want you to understand that liabilities that we have less than a year to pay are current, and the ones that we have more than a year to pay are non-current liabilities. All right, so that is it. Okay, so we look at capital. Now, what is capital? We know capital. I know, of course, everybody will tell you capital is the amount of money used to start a business and all that. It's true. But capital is the financial obligation of the business to the owner. So, how much, or the owners, how much the owners have put into the business is capital. Now, in the case of partnership and sole trader, it's capital. In the case of a company, usually it refers to the shares and other reserves. Okay, so this is capital. So basically, it is a financial obligation of the business to the owner. Now, let us not forget that the business entity concept teaches us that the business is a separate person from the owner. Okay, so if this is the business and this is the owner, okay, the business is a separate person from the owner according to the business entity concept. And so whatever the business puts into the business, the owner puts into the business, is seen as an indebtedness to the owner. The business owes the owner. Just like outsiders, these are all outsiders, okay? Now the business also owes outsiders who have put their money in there. And this one is what we call the liability. Now the owner is a special kind of liability there. Indebtedness to the owner is a special kind of liability. And that is why we call it capital. Okay, and so capital is just like a liability because the business is seen as a separate person from the owner. So capital refers to the obligation that the business has to the owner, or the owner's money, or the resources of the owner that is in the business. That is your capital. All right. So we have 3 different forms of capital. As far as the financial statements are concerned, we can discover 3 different forms of capital. Now we have the working capital, we have the capital employed, and then we have the owner's equity. These are 3 different types of capital, and I'm going to explain each of them. So I'll begin with the working capital. Now, what is working capital? Working capital is simply the excess of your current assets over your current liabilities. That is your working capital. So in every company, we expect that your current asset minus your current liability should be positive. And this is what we call the working capital. When your current assets are your short-term resources. Your current liabilities are your short-term obligations. Now, the net of it is what we call the working capital, and that is the capital that you are using for day in and day out running of the business. And we expect that the working capital should always be positive to tell that you are financially sound as a business and that you are not having any liquidity problems. Now, if this working capital runs to negative, and what I mean by negative is that when the current liabilities become more than the current assets, then we are going to get a negative working capital. And a negative working capital is called overtrading. It means that you are overtrading and you have to be careful as a business. We always expect, for example, that if your current asset is 50 and your current liability is 40, then you are getting a working capital of 10. Now, if your current liability rises to, let's say, 80, you are getting a negative 30 working capital. And this is what we call a typical overtrading situation. Overtrading. So overtrading is a term used in accounting to describe a situation where the working capital is negative or your current liabilities exceeds your current assets. So working capital is the excess of your current assets over current liabilities. But when the current liabilities exceed the current assets, we have overtrading. So this is working capital, and that is the formula for working capital. Your current assets minus your current liabilities. All right. So the second form of capital we are looking at is capital employed. Capital employed is the excess of your total assets over the current liability. How does that change, or how is it different from working capital? Now, your capital employed, which I'm calling CE, it's your what we call fixed assets or your non-current assets plus your current assets minus your current liability. So the only thing that has changed with the working capital is that we have introduced a non-current asset variable here. And so what we have done is that now these two is what we call your total assets. Okay, so now total assets of the business minus only the current liability is your capital employed. And that is what we mean by capital employed. And so when you are given figures to calculate this, you should be able to calculate your capital employed from a given set of financial data, having this formula in mind, that your capital employed is your non-current assets plus your current assets minus your current liability. Okay. And then we have the owner's equity. Now, owner's equity is also different. Owner's equity is the excess of your total assets over your total liabilities. So in this case, we are looking at netting off all liabilities from your assets, and the difference that is left is what the owners have. So your owner's equity will be equal to your non-current assets plus your current assets in brackets minus your long-term liability plus your current liability. And this is the owner's equity. So it is netting off all your liabilities from your assets. Now, let us remember that liabilities or outsiders also have a claim on the assets of the business. And so when we take off their claims from the assets, the difference that is left is the claims of the owner on the assets of the business. And typically, this is the formula for owner's equity. And so given a set of information on our financial report, we should be able to calculate using these formulas. Calculate your working capital, calculate your capital employed, and so calculate your owner's equity. All right, so that is it.